Hey, Guaranteed Retirement Guy here, and I want to talk to you about the roll-up rate. I've created some other videos in the past about this, but I want to dive into it a little bit more because this is really, really important for determining income for your annuity. So a lot of annuities will have what we call a roll-up rate. And a lot of times you might just hear a guaranteed 7% growth for income, or 8%, or even 9% growth. And a lot of times what we think of when we hear of 8, 9, 10% growth, we're thinking, all right, well, if it's growing at 8% and I've got 100,000, then I should have $8,000 going into my account that I can withdraw. That's not the case for a rider, an income rider with a roll-up rate. So an income rider is really just for income, and typically that rider, it gives you guaranteed income, but a lot of times what it will also give you is a roll-up rate that's guaranteed as well. So if the index is just doing terrible, then at least you know you're earning that roll-up rate of 7 or 8%. That's pretty nice. So if the index is doing 0 year after year after year, let's say it's a down market, you're not losing anything, but you're not making anything in that account. Your account balance is not looking great. Over here, your income value is growing like crazy because it has that guaranteed rate of return. And since you purchased the annuity for guaranteed income, it's perfect. So that is why it's so valuable to have an income rider attached to an annuity. If that is what you're looking for, if you're looking for guaranteed income, then it's great because it'll give you a roll-up rate that will determine your income. So I'm sharing my screen and I wanted to show you what this looks like. And really the best way for me to illustrate this is just to stretch this bar out here about 15 years so you can really see how that roll-up rate affects the growth. Okay, so you see here the top one, if you were to put $500,000 in here, they're showing you, if you put $500,000 in here and you're 60 years old and it's a single payout, then at age 75, the guaranteed payout amount is $103,332 per year for the rest of your life. And factors can be a lot different. If you might be 50 and you're looking to retire at 65. Okay, we can look at that and that'll change things up on this. So there's a lot of different factors to look at. And if you want to book a call, we can go over that specifically for you. Okay, so if I look at monthly, of course, it just breaks it down monthly, $8,600 a month with American Equity. You got Sentinel Security, you got AIG. F&G, Athene, all these other ones, okay? So I'm going to remove that back to annual, and I'm going to look at the roll-up rate in further detail. You notice this says 7% roll-up, so let's look at that. So 7% roll-up, and this is with American Equity, and they're actually giving you a 10% bonus on the premium, so the account actually starts out at $550,000 if I put $500,000 in there, which is nice. So, but here's what they look at, and you'll see the income base column over here on the right. You notice the income base starts out at $588,500. That's after the first full year. So it has $550,000 that gets that 7% applied to it, and now it's worth $588,500. You'll notice that happens again on year 2, and then year 3, and so on. And so the value in this is because, I mean, if the index does really bad, we got 15 years of a down market where it just does nothing. You can see, here's what it looks like. If there is no growth whatsoever, your account balance by itself is not going to look that great because, you know, we're charging you a rider fee. I think it's like 1.1% on this. So we're charging you a rider fee for guaranteed income. So that is, and I'll show you what it looks like without the rider. If you don't want the fee, that's fine. You don't have to have the fee. And you can kind of decide for yourself, you know, which one you would rather have. But they're showing you, hey, if this earns nothing, which is a very extreme example, it usually earns a pretty decent rate of return. But let's just say it earns nothing. If it earns nothing, the roll-up rate, which is still earning 7%, you'll notice at the end of 15 years, the actual account, the account value of the income base value, so this isn't money you can withdraw, but this is still a real value. It's grown from $500,000 to $1.3 million. That is phenomenal. And now you've got a lifetime withdrawal rate, which has also been going up, and this is contractual, this is guaranteed, part of the contract, no matter what happens. The lifetime withdrawal rate at age 75 is 7.85%. So 7.85% multiplied by 1.3 million is $103,000. That's really, really, really nice. And then, of course, if you want to see the hypothetical, it shows, all right, well, If the account grows, it might grow to $600,000 or $700,000. Just depends on what the index does. Either way, we're still going to use the income base of 1.3 million because we've given you a roll-up rate of 7% guaranteed. Guaranteed. And the lifetime withdrawal rate has also steadily gone up every single year, guaranteed. And so regardless of what the index does, regardless if your account value is worth $700,000 or $800,000, if you want to take your money out at the end of 15 years, you can do it. If you want to take it out before then, you can do that. But it's not going to generate the kind of income that the income-based value will generate because that's been growing at a 7% rate. So it's pretty nice how that works. Let's see. If I were to go down to, let's say, Corbridge Financial, which is AIG, I'll just pull that up real quick, show you what that looks like. You notice that their income-based value grows a little bit, a little bit slower. So I don't know what they're paying. I'd have to look at this, but it looks like they're paying maybe 6%. So it's not a huge roll-up rate. And you notice that the income base goes to about 1.1 million, a little over that, by the time you take income. But the withdrawal rate is higher. It's 8.35%. So, but they're still giving you less income. The income is like $94,981. So $95,000. So it's still like $8,000 less than American Equity is giving you. And it's just because their income base did not grow as much as the American Equity gave you. So, that's the thing is a lot of times they'll give you a higher lifetime withdrawal rate, but the income base won't grow as high. And because of that, when the two numbers are multiplied against each other, the 1.137 multiplied by 8.35 only gives you $94,981 per year. You have to look at both numbers. You have to have a high income base, which you want a roll-up rate as high as possible. And then you also want a lifetime withdrawal rate that is high. Because a lot of times you can get a very high income base, but have a super low lifetime withdrawal rate, and the numbers don't work out for that either. So my software just basically shows which ones are on the top, regardless of the math that they're using to get there. So, and then you got the rest of these. I mean, you got Athene. You can see how Athene works. It's giving you less income. And you can see the income base here. Look at this. The income base here grows pretty dramatically. The first year, it's worth way more than American Equity. It's like $710,000. It's way more. And then you notice at the end of 15 years, it's worth $1.4 million guaranteed for the income base. That's more than American Equity. A little bit more, not much more, but still more. But here's the difference. The lifetime withdrawal rate is only 6.7%. You're not in the sevens like American Equity is. So again, when 1.4 million is multiplied by 6.7%, it's only giving you $93,800. So that's lower than American Equity gives you, and that's just because the lifetime withdrawal rate is lower. This is just something to think about. I mean, when you're looking at income riders and with roll-up rates, and you're wondering how does a roll-up rate affect me? What are they talking about when they're saying a 7 or 8 or 9%? What does that mean? I mean, that's all great, but it's usually a marketing ploy to get you into an annuity, and you think, oh, this is the best annuity because it's making me 9% on the income. The problem is, if it's earning you 9%, the roll-up rate is earning you 9%, and you're thinking you're making all this money, and your account value is growing so much, you're gonna get all this income. You also need to stop and take a look at the lifetime withdrawal rate, because if that lifetime withdrawal rate is super low, it's not going to matter if your income base is earning 9 or 10%. If you don't have a high enough lifetime withdrawal rate, it's going to be lower than the other ones that have a lower roll-up rate, and a higher withdrawal rate. So you got to have a good combination of both. And so that's why American Equity kind of gives really the best of both worlds. I'll just go back into that. So we got 7%. And they're giving you a 10% bonus, which is nice. So that does help. Yeah, the income base is not $710,000 like Athene, but the lifetime withdrawal rate is higher right in the beginning. And then you'll notice over time, it doesn't go to 1.4 million, only goes to 1.316. But instead of, you're getting more than a 6% increase on the lifetime withdrawal rate. You're at 7.85. That's almost 8%. So that's really important. They're giving you a healthy roll-up rate, and they're also giving you a very generous withdrawal rate at the same time. So when they're both multiplied against each other, that's what gives you that guaranteed income. So that's really important to think about. And remember, the roll-up rate The roll-up rate is a standalone rate. It grows your income base regardless of what happens with the index. The withdrawal rate is dependent on if you are single, taking the money, just a single payout, or joint. Okay, so let me show that real quick so you can see that. So remember 7.85? Is that what it was? Yeah, 7.85% on the single payout if you are 75. Okay, still the same 1.3 million, right? It's still, the roll-up rate is the same. So let's say in 13 years, I get married. I'm single, I get married, we're super happy, and I'm like, all right, I was going to take this single, but now I'm going to take a joint. You could do that. It's the same contract, so the contract keeps growing, and you decide at the end of, you decide when you actually take the income if it's going to be a single payout or a joint payout. So if I were to do that, then I'll just say, all right, well, I got married, and my new wife, let's see, a year younger than me, okay? So she's 59 when I was 60. But anyways, let's say I married her 10 years into this. So 10 years into this, I'm going to say, all right, well, I'm going to turn on joint income. It's the same annuity. Okay, it's still earning the same 7% roll-up rate because you notice the income base here doesn't change. You see that at the end of 15 years, it's still 1.3 million, 1.316, same number. What is different is the lifetime withdrawal rate. Lifetime withdrawal rate is not 7.85 for just a single payout. Now it's 7.15. Okay, so very important to know that obviously if you're married, they're going to take into account the other spouse. And of course, if she's older than me, that lifetime withdrawal rate will be higher. It's just because they're on the hook for both of your lives and they adjust it accordingly. So again, if I wanted to take a joint income, it's $94,000. It's still the highest joint income in 15 years. And I know that if I fund the annuity right now, I don't have to decide right now if I'm going to take a single or joint. In fact, I don't even have to decide what year I'm going to take it. All I know is that I have a roll-up rate of 7% that's growing this guaranteed, and I have a lifetime withdrawal rate for a single and also a joint that is growing guaranteed. It's going up every single year, and I can elect when I want to turn on the income and if I want to turn it on single or joint. So the magic of this whole thing is the roll-up rate. And when that roll-up rate is applied every single year, that is what gives you massive value in these annuity contracts. So, and that's really the reason why you can justify paying the fees. Because look, I'll show you, if you don't pay the fees, right now I'm paying what, 1.2%, which is not even affecting me. It's just happening inside the account every year. They deduct it from the account balance, and the growth, whatever the index earns, also gets credited to the account. And whenever I turn on income, it does not matter what the account balance is. It does not matter at all. All it matters is that the roll-up rate has been applied 7% every year to the income value, and that's all that matters. Okay, the growth and the fees and everything, all that affects is the cash value and what I leave behind after I die. That's all. So, and if I'm married and joint, it'll leave behind whatever money is left in there after both of us pass away. The income is not affected. All right, so if I decide I do not want a fee, I don't want to pay for any roll-ups, I want a super low roll-up. So you'll see they'll give you an option. We'll say, all right, we'll give you a 4% roll-up rate. Well, all right, 4% roll-up rate. That only gives me $53,686, quite a bit less. What is it if I have a single payout? Okay, it used to be $103,000. Now it goes down like 40% to $60,000. So, but I didn't want to pay a fee. And so I'm just looking here and say, okay, well, I'm getting a 4% roll-up rate. So you see that income base here now? That's growing a lot slower. And also they give you a lower lifetime withdrawal rate. Okay, so the fee that you're paying gives you a higher lifetime withdrawal rate, and it gives you a higher growth on the income base. And so instead of a 1.3 million multiplied by 7.85, with the fee, without the fee, it's just shy of $1 million multiplied by 6%. It's almost 2% less on the withdrawal rate. And so when you're thinking about the fees, think, all right, well, is it worth it for me to spend an extra $80,000 in fees for a higher roll-up rate? Well, you do the math. It's $40,000 more in income every single year. And if you do that over 30 years, that's like $1.2 million in extra income. You tell me, is it worth it to pay an extra $80,000 in fees for that extra income? And I would say most people would say yes. So it just depends on what you are looking for. See, a lot of times if people don't want income or they don't care so much about the income, then doing something with no fee is fine, because maybe you want to leave behind a larger balance to the kids. So you can do that. It just depends on what you want. If any of that is something that you want to go over, you have a personal situation that you want to look at, and you want to see how the roll-up rates will affect you, especially if you let that roll-up rate work for you over time and you want to see what kind of income that's going to look like, then book a call. You'll notice that there is a link below this video. It goes directly to my calendar, and we can talk about your specific situation, exactly how much guaranteed income you want, and exactly how the roll-up rates will affect you over time. So anyways, thanks for watching, and I'll see you in the next video.